I think in the coming years, if you're not doing CPACE as a lender, you're not going to be competitive.
Welcome to the CPACE Confidential, where you'll hear about the hottest happenings in the world of CPACE, commercial real estate, and beyond. We speak with the top players doing the most exciting projects and discover just how CPACE has evolved into one of the most innovative financing options in the industry and how you can use CPACE to be more successful in your business today. Now here's your host, the CPACE guy, Adam Lipkin.
Hey, everybody. Welcome to the CPACE Confidential. I'm your host, Adam Lipkin, the CPACE guy. We're in November. It's wild, amazing, kind of rounding out this last quarter of the year. Weather's amazing down here in South Florida. It's nice to be able to see it cooling down a little bit. Was at a really fun in-person event last night. I want to give a shout out to the group that just did such a tremendous job. But it's nice. Want to invite everybody from out of area. Good time to take a trip down to Miami and South Florida for the holidays, for sure. Weather's getting into the 60s, paradise season, as I call it. But just want to kick off the show with an announcement, and then we'll jump into some news and our guest today, who I'm really excited to have on the show. So I just want to kick it off. I want to give a major shout out to Profile Miami. We got Katya and Dimitri. You guys did an absolutely tremendous job last night at your kickoff event. Had such a great time. It was hosted by Ronnie Finvarb, who's just really, really iconic down here. Completed his Palomar on like such a key destination spot on the beach, like right at Alton, Dade. I mean, absolutely such a cool design. The event was on the rooftop, and it was just tremendous. We had Gil Deser, we had architect Kobe Karp, and Ronnie said some words. His attendance was just great. It was really, really awesome. Well done. I feel like we need more of these kind of events. So I want to really give a great shout out to Profile Miami. Guys, check them out if you haven't already. You can subscribe on their site. Really great content. Ronnie actually just had an awesome interview. Talks a little bit more about the project and also the Thompson that he's doing over on Washington 17th. So highly recommend checking it out. And just kind of jumping right into the news. I'm always like checking out what's happening on LinkedIn, Twitter, like some of the feeds, and certainly in the industry. And a buddy of mine that I've known for several years in the industry, Nick, who we're going to have on in just a few minutes, I'm on my feed and I see him post this. It was a week ago, and he's talking about doing an 80% hotel construction loan with CPACE during COVID. I'm like, dude, you're doing the impossible. We got to have you on the show. We got to hear what you're doing in this space. And he was awesome to be able to jump on today. So we're going to have him on in just a few minutes. But I asked a question last week and I said, some call CPACE super senior debt. Some call it replacement equity. Which one is it? And it's, how do you look at it? Is it debt, equity? I purposely wanted to word it like that because I also added the option neither. And so it was interesting to see the responses I got. Roughly half called it debt. Pretty much all the lenders I know and a number of advisors put it in debt. There were just a couple guys that called it equity. And then the remaining, I'd say almost half, called it neither. And that was most of the guys I know in the CPACE industry and a number of advisors I know too. And I just thought it was interesting, like the makeup of how people view it that are familiar with it. I mean, I would definitely put it more in the camp of neither, just being an assessment. And I see how it has certain properties that could resemble debt and certain properties that could resemble equity. But I really make it a point to differentiate it as something that's neither. And I think that it's important to know how to introduce things that are new. But I definitely get how folks call it debt. And I think it's challenging when it's called equity. I think that's actually something that needs to be revisited. I'm good with neither, but I think equity is a little bit of a stretch. So anyways, in that note, I want to bring on Nick Barbaria, who's the president of Arriba Capital. And Nick and his team, just awesome in the industry. I really got connected with them several years ago and was impressed with how scrappy they were. They're like real hustlers. I felt like when it came to hotel financing, they just would know about a lot of the innovative things happening. They, when I was talking about CPACE a few years ago, you were aware of it, knew the challenges with it, just see a lot of unique ways of structuring deals and specific expertise when it comes to hotels. So I wanted to get Nick on. I wanted him to share a little bit about background, some of the creative things that they're doing. in a really, really tough time. Just how it evolved in COVID from last year, probably being worst ever, to now, just this incredible bounce back in momentum in a lot of markets. So looking forward to having Nick on. So with that, I want to bring on my guy, Nick Barbaria, president of Arriba Capital. How are you, my friend?
Good, Adam. Thanks for having me. I appreciate it.
Man, this is great. It is a really nice opportunity to be able to catch up with you too, and just kind of get a little bit of a perspective from what you're seeing, what you're doing, and kind of get into it a little bit. So look, I think I got connected with you guys 3 years ago. I was basically introducing Pace to all my guys I knew in the industry, and I kept on seeing the group coming up a lot over hotels, and I was spending so much time in that space. And I really felt right away, you guys, you got it. You were seeing how through best execution, as many options as you can, you could really get client needs met, right? So you're looking at everything, all sorts of solutions. And CPACE was something that, I felt like was interesting. So fast forward, it's probably been, since COVID, right? That's like the conversation these days with a lot of us, where it's like, haven't really talked to you guys much. I think I talked to one or two of the guys on the team, maybe beginning of the year, but maybe you could give us a little bit of a background about Nick and kind of how you got started with Arriba. I think it's such an awesome story when you take a company you founded and you grow it, and maybe just then we'll jump into like what's happening now and what's been it like through COVID. So tell me a little bit about background.
So like most people, coming out of college, they don't really know what they want to do with their lives. And I had a lot of friends that were kind of already in the, commercial real estate, financing industry. Some, went to college, some didn't. And I was just intrigued. It seems like, they were doing all right. And, I kind of just jumped on the bandwagon and, went to work for a firm, that really kind of, taught me a lot about it. And, after a couple of years, I thought I knew enough to, start my own firm and kind of go out on my own. I think that was because of, we were seeing the deals that we were getting done, and then my paycheck at the end of the day, and it didn't match up. So
yeah. What year did you make the move?
Oh God, this is probably 12 years ago. So Arriba's been in business for about 11 years now, I'd say.
It's an interesting time. We're talking like 2010, right? 2000-ish, right? Like, you're coming out of the recession, you're starting to see movement, but it's interesting. I felt like it's very similar to, you hear the trend with the Great Depression, how so many businesses get started in these real tough times, just being, resilient and, everything that you need. And how I felt like there's a lot of guys that took that time, that you almost had like a reset to get creative and did some really unique things like starting platforms. So it's an interesting time to get it started, but you've clearly grown it. You said 10 years in?
Yeah, 10 or 11 years in. We went from, 2 guys to 6 guys now, doing, 1 or 2 loans a year to, 1 or 2 loans a month now.
Yeah, it's amazing. It's a great story of growth. So, you got the company started, you've grown it over, now over a decade. I don't know what they say the stat is, that, what is it, like 90% of businesses after the first year don't make it, and then another 90 within 5 years. So, you're in good company, and being able to get something 10 years, something to be proud of. Really awesome, man.
It's definitely not easy. Starting your own commercial real estate, mortgage business. And, I had to learn the hard way. I didn't, really have a mentor to kind of, I think, coach me along the way, like a lot of people do. But,
Sure.
I think I look back on it now, and I laugh, because I think I've learned a lot of good from, some of the mistakes we've made in the past.
Yeah, I was gonna say, is that what you think? One of the kind of things that you could attribute is just trying a lot, and just kind of failing forward. You felt like you found yourself just trying a lot of things, and not like kind of holding back, wondering how it's gonna go.
Yeah, you don't succeed if you don't fail a few times,
For sure. So let's talk about, so you've been at it for a while. I feel like I saw a lot of activity, 18, 19. So 20 comes along, and we've probably been talking. Let's talk about even a little bit about CPACE history with it. Like, when did you first see CPACE show up on your radar?
I would probably say like 2017.
Okay.
Yeah,
Was it me?
it might have been. I mean, you with your
Were you like, hey, who's this guy? Like he was telling me about it.
yeah. I mean,
I do have that happen a lot. I feel like if there's one thing I could claim, I could say I introduced a lot of people to it for the first time. So
yeah. I mean, at first I thought it was a fad.
yeah.
Just hey, it's another thing that's going to come and go.
Yep.
I really didn't pay much attention to it, probably like a lot of people. And you kind of fast forward today, it's becoming, much more, mainstream.
Let me ask you a question though, back to that. Like when you thought it was a fad, like, so I imagine somebody talks to you about it the first time and they tell you all the sales point. Oh, you're going to, and they might have oversold it too. Like, I don't know. I think it also depends on how it's introduced, but at some point you make some like assessments about it, right? You kind of are like, okay, this is kind of how I'm hearing it. Did you immediately say, I don't know, can I do anything? Or did you like have like a stopping point? Like maybe you tried to run it by a lender or a bar or somebody, like what had you come to that conclusion? Like at that time, I don't think this is anything to spend time on.
Well, I think once we found out, from a client that they did a C-PACE deal and they, kind of told me, how they got it done and, the benefits of it, I said, well, wow, this is something that we can definitely, kind of blow up and announce to some of our other clients and get them in the same, financing structure that our one client that I just mentioned had. And I think it's very, advantageous and it's kind of outside the box and
yep.
Not too many people are doing it. So yeah, I mean, it's definitely benefits or it's definitely beneficial, today.
So it's interesting. It's always like, because you see a lot, right? You see lots of products. You kind of have to play a little bit of a filter game to know, like, where do I invest my time? I only have so much time to spend on, that there's certain things that have higher probability of hitting than not, right? So you kind of have to go through that. And I imagine one test for a lot of people are, have I seen somebody I know doing it, right? Like I imagine that comes up for people. It's like somebody comes to you like, hey, you could do all this great stuff. And you're like, why haven't I seen it, right? Or why haven't any of my clients mentioned it? So, right, I imagine there must be something like that comes up. And it sounds like you're aware of it, but maybe when this one client of yours, and maybe tell me a little bit about that backstory, like when that happened and, how you kind of immediately connected the dots and said, oh, you know what? If I know they're doing it, everybody would at least be interested about it.
Exactly. I mean, this was a very well-respected client. So I had an issue of, taking a good client and having him be the guinea pig,
sure,
for a transaction or something.
Let them ask for it, right?
Yeah,
I'll help them if they want it, but I don't need to
introduce. Because if it blew up in my face, I'm going to be the bad guy.
It's a completely valid concern. I think it's like that with a lot of either a new lender, all sorts of those things where you got to really balance that. You want to introduce innovative ideas, but you don't want to have somebody trust in something that might not have a track record and have it really, be an issue. So I get it. And it's good to hear perspective about what it's like when you start to make decisions around innovative things, new things, because we, especially with like technology and a lot of things that we're seeing more and more possibilities of being successful with, all sorts of things in innovative ways. And you just kind of have to really know, how do I determine where to spend my time? Yeah.
Definitely.
So you saw, okay, we got a guy that has a lot of respect, who's already getting a lot of things done. He's asking for it. Did that change your perspective on, oh, interesting, like these guys are now doing it or asking about it? Like what happened when it came to when that conversation came up?
He told me about it and kind of told me, how it came about. And I always hate learning from clients, right? I like clients to learn, from me.
Yeah.
That was kind of a role reversal right there.
Right. So yeah, so tell me, you can tell me a little bit about, you don't have to name the guy, but just tell me a little bit of background. Is this is somebody you've done business with already, or somebody that you're trying to do business with? Had you already had
a big hotel guy, owned 20, 25 hotels, somebody that we've done, a loan or two for in the past. And,
yep.
So it's, hey, if this guy is knows what he's talking about. So if he's telling me it's legit, then it must be legit.
Got it. Let me come back to that, but just for a moment, let's talk about also like last year when COVID first hit and it really had the whole industry get shut down. I mean, obviously some industries got hit harder than others. Hotel got hit, I feel like, as hard as it gets. I mean, really took a hit when it comes to real estate asset classes. Retail, hotel were the ones that everybody was like, oh my God, what is happening? We have no idea, no playbook for this. What was that like? You know, I don't know what percentage of business was hotel at the time, but I know for me, at least, it was a ton. I mean, maybe 80+% I had active business that was C-PACE with a hotel for either development or some kind of transition. And it was like, it was just done. You know, it was just done in March. And there was just no movement, I felt. So tell me a little bit, what was it like in your world? Did you have situations where it was just kind of on hold? And then I'd love to hear how that evolved.
Yeah, I mean, it was a rude awakening. I mean, we had $100+ million of active deals, you know, under application and in various closing stages, and everybody just seemed to get, you know, cold feet. It was, hey, you know, we need to wait another week to see how this plays out, and you know, and that week turned into a month, and then finally, I think we just realized, hey, these deals aren't getting, you know, done. The world's on fire. All the lenders are pushing the pause button. And yeah, I mean, it was strange times.
So it's like basically just on hold. And then when did things start looking like there's possibility again? And when did you guys start kind of getting smart about, here's what we could do, here's how we're going to position ourselves? Because it seems like there's been a real, like, certainly this year, ton of momentum. Seems like you guys have been really active. When did things start to shift with you and the group?
Yeah, I mean, we've been really active on the construction front. I would say probably we saw the light at the end of the tunnel probably the start of this year, maybe March.
Yeah, okay. And what did it make up of? Was it more like multifamily? Like, what did you find you were getting done earlier in the year?
I mean, we had a few like storage and multifamily deals. I mean, they were kind of the darling asset class that everybody would still do. But our biggest asset class that we finance is hotels. I'd probably say it's probably 70% of our you know, overall business every year.
So let's talk about how that evolved, because I saw last year it was just every hotel lender that I was close with basically was just like, we're on hold, and it was all focused on the existing portfolio. Definitely through second quarter, probably even third in some cases. And then I felt like towards the second part of third quarter, you know, maybe September, maybe earlier, but probably around September, October, it was, hey, we're going to look at low basis for existing. Nobody was touching construction. Everybody would say the same thing. Oh, we'll do existing, you know, maybe help things get, you know, just through the next year or two, whatever the ramp up period looks like, but nobody was doing construction. I was like constantly getting these requests for hotel construction, and I'm like, I could do the C-PACE, but who's your lender, right? I mean, it was like, and nobody was really stepping in. So when did you start to, well, first of all, did you see that, or did you see that there was still hotel construction options last summer or fall? Tell me what was showing up for you.
No, there really wasn't any hotel construction options last year. As far as, you know, maybe some acquisitions or refinances, we saw some getting done at very, very low leverage, like 40% leverage.
Right, like under 50%, right? Yeah, exactly.
Or they were like SBA loans. You know, the government increased the guarantee from 75% to 90% on the SBA loans. So that kind of incentivized lenders to, you know, start lending to the hotel business again because they had that higher guarantee.
Did you guys get that machine going? I know some groups that were just like going crazy with that. Just
trying
to make that like almost like just like a machine, literally, like just try to process.
Fair share of you know, SBA loans. Yeah, I think it was through, the incentive was through September 30th, where they had that 90% guarantee, and I know there was a mad dash to get those loans closed before then, because there was a much bigger premium in it for the lenders and a much higher guarantee. And you know, if you're telling me I'm a lender and I only have 10% risk on the loan, I mean, you bet I'm gonna, you know, be making some hotel loans.
I feel like that philosophy is go where there's a hot pocket of capital and almost back into who would be able to best use that. Like, I felt like, because I'd been in the industry, you know, I guess it was probably 2005 that I really jumped in and just spent a lot of time looking at, you know, what are interesting capital sources. And this is also like back in the last cycle when people were doing some very unique things, converting condos and having certain lenders that were jumping on that. So there's just different profiles for different people. I think with PACE, what was interesting was, could you find like a hot bucket where there's the lender with PACE, or they do the whole thing and you get the higher leverage and you just run with that for a scenario. And for a while, it looked like that was going to be hotel. I had some success doing that with hotels, and then it really shut down with COVID. So what I was really intrigued, and I'd love for you to share about it, what was like the high mark earlier this year that you had gotten done with construction for hotel without PACE? What was like the highest leverage point that you were achieving or that you saw was available realistically?
Probably 60 to 65. But I mean, those lenders that were doing it, whether it was a bank or a debt fund, I mean, they wanted to get paid for it. They were taking advantage of the times, probably just like anybody else. If I'm going to do a hotel,
not 10% or so, 9-10%.
Yeah, thereabouts, maybe
higher.
No, well, I mean, I meant maybe a little bit cheaper,
Okay, maybe 8 or so, 8.5. So right. You have the guys initially early in the year, having gone from doing hotel to multifamily to then coming back to open to hotel, but lower leverage. And 60% was maybe what was showing up, maybe 65, but that was beginning of the year, right?
Yeah. Again, most of the lenders, I think they wanted to be kind of the trailblazers and said, hey, we either think the hotel world's going to come back or we don't. And if we do, we need to be out there booking these quality clients that we wouldn't have, had the opportunity to a year ago, let's say a Wells Fargo client or somebody else. And if we're going to do it, we're going to get paid for it as well.
So what do you guys do at this time? Like when you have clients that are sitting on projects that they're just kind of on hold for these months, and I imagine you're constantly testing your core 10, 15, 20 lenders that are your go-tos like each month or every week even. Hey, how's it looking? What can we do? Like, I mean, I imagine it was who's going to step up first somewhat, right?
Right. Yeah. I mean, the lenders that we work with closely, knew that we had a stable of quality business. It was just, let us know when you're going to turn, the spigot on and
right, for sure.
And, finally we got a couple of those calls and, we ended up getting some, a lot of construction deals done,
So let's just jump into that. So let's talk about some of those profiles. So that happened in March, April?
Yeah, I would say March, April-ish.
Spigots are back on, my friend, and you start getting your deals done. And what were some examples that were getting done like in April, May? Like give me maybe one that stands out for you when you're like, we're back.
Well, we had a construction completion deal, up in the Bay Area. That lender, pulled out due to COVID and just kind of left our client high and dry. And,
okay, so it's like 70%, 50% mid-construction?
Yeah, I think it was 65, 70%. The shell was up and still needed to do the drywall and everything on the inside, but really kind of left our client, high and dry. And, we stepped in, did a construction completion loan on that deal. A few other ground up deals where, like I said, we had some banks that, only wanted to do, quality deals, Hilton, Marriott, quality locations, quality sponsors. So we were able to get some banks on board at, 60, 65 leverage, and they were, PACE friendly. We didn't have to, educate them on PACE. And
so let's talk about how was that working out? It was a ground up construction.
Yeah, ground up construction.
And it was the bank was in for 65%?
Yeah, 60, 65%. And then
so the bank's in for, let's say bank's in for 60%. What's this, like a $30 million deal?
No, probably a $15, $20 million loan.
Okay. But on the total project size, it was like 30 or so?
Yeah, 25.
Okay. So $30 million ground up hotel. Bank comes in, says they'll do 20 million, about like around 65%, right? Mm-hmm. And you have PACE come in to go higher, or what ends up happening there?
Yeah, PACE to go higher, up to 75, even 80%. I think we've done, a handful of deals at 80%. I know that you just saw the one in Northern California that we did, the Aloft, but I mean, we've done a handful of those deals prior at 80%. no issue.
So let's talk a little bit about like the underwriting on that. So this is a bank, and again, you don't have to reveal your sources. Who's the like bank profile? And I guess really the question is this a bank that's pricing in the 3s or 4s, like under a PACE rate?
No.
So this is a private bank.
No, well, they are a private bank. Excuse me. They're not publicly traded. They're a pretty good sized bank. I'd say below $5 billion in assets. We work with a couple, depending on the location, some are kind of, regional players, some are national players.
So when it comes to like so this is how I thought a lot of times of what should be doable with PACE. And we'll get your take on this too. So if somebody looks at it as like, this is super senior debt. And again, my take on it is it's a super senior tax, which is what a property tax is anyways with no rights. I think you have to take it into account. You got to still be aware of basis. You got to still pay attention to coverage ratio to make sure you have income to cover ultimately the PACE assessments. But there's some folks that really just say straight up won't do it. Other folks say we'll replace our dollars with it, which I think is at least just, look, and candidly, that's maybe where we're at now. I do think at some point you'll start to see folks say, I'll run this up to a combined scenario similar to where I would run up a pref or mezz. And as long as my detachment point is sufficient to get me to take out, I'm okay with going a little bit higher too. So I do think it's going there. But for now, I found that over the last several years, there's more and more private lenders that are priced at 8-9% or more that typically are basis driven and might say, look, okay, I'm okay at 70, 75, 80% of cost, because on value, that's 65% of value or whatever it might be, 70%, probably closer to 60 or so. And I'm willing to lend at a combined level between my loan and PACE at X, wherever that is. Let's say it's 70%. If you want to bring in PACE, I'm just going to replace out my dollars. And so you want to bring in PACE for 20%. I'll do my loan at 50. You come in for 20. We still stay at 70. So I'm curious, like, how did that play out with this one lender that you're talking about that basically you're saying they did 65%? Is it more they did 80 and they just pared it back to 65 to get more, competitive price wise? Like, how'd they determine like what's the basis and how much PACE they'll allow?
Yeah, I think they were comfortable at 80 on all these transactions. And one of your questions at the onset was, hey, is PACE, debt or equity or neither? I'd actually say it's, from the, lender standpoint, they look at it as debt because, one, it's a payment and, they think it primes their mortgage, but two, some of them look at it as well the same way as, hey, it's not my dollars. So if it's not my dollars, then it's equity,
Yeah, it's interesting. Like when you think of other products that have just, kind of been around for the last decade more actively, like EB5, like how some lenders just don't like any EB5, some like a certain amount. They maybe want to have the borrower team have some minimal amount, and there still needs to be a total amount of equity. But I do find that there's a variety of ways of underwriting it. So there's maybe more of a coverage test in some cases. But let's go back to this example. So it was a roughly $30 million deal, right? And you had 20 of PACE, and was it 20 of debt and 5 of PACE? Is that what it looked like?
Yeah, it was about $6 million of PACE. So yeah, I mean, as long as it pencils out the PACE and the senior loan at 80%, I mean, we can get those deals done.
Was it the lesser of 80% or like 60 of value, or how do you, like, when you saw the underwriting? And it sounds like, is this a lender kind of PACE combo that you've done now a few times? Is this like a go-to that you have a good handle on what the underwriting looks like, right?
Yeah, they actually just took a little pause on hotel construction lending because we filled them up with a couple $100 million and they need to digest some. But
good problem to have,
Yeah. So I mean, they're looking at a combined debt service ratio of 1.3, 1.35, something like that.
So they'll basically look at the PACE as above the line. They'll call it an operating expense and say, as long as your combined coverage with the PACE is still north of 130, 135.
Yeah, and from a loan to value, like a stabilized loan to value, they probably want to be in that 70, 75%, stabilized loan to value. So, you got to imagine if you're building something 80% of cost, that the stabilized value is more than the cost, right?
Oh yeah, for sure. The question is it you're going to be 10% lower? Is it 5? I mean, I would think for hotels, like, I mean, I guess it depends on how people are, there's very conservative valuations last year for sure. I don't know. Maybe that's a question for you too. Have you seen valuations come in better now over the last year? Are people more optimistic than when you're trying to, not that there was much activity last summer, but yeah.
We haven't had a short appraisal this year. Let's put it that way. And we've done, a dozen deals.
So it sounds like really the lenders that are most friendly are focused on a coverage test and a stabilized to value test. And they're not as concerned necessarily about the loan to cost if your value's there and you still have sufficient coverage.
Right. And most of the CPACE lenders that we work with, I mean, they have, an interest only period for a couple of years, anywhere from 3 to 5 years. And they'll capitalize the interest for, 3 years. So most of the construction loans are 3 years, to get you built and stabilized. And then, you go to a long-term, fixed rate, financing. So from the eyes of most of the lenders that we work with, if you have 3 years of interest capitalized, that gets them through the whole term. And before anything goes sideways, on the CPACE on their loan, they're out of it.
It's such a good point you brought up, because that's such a big component of the risk for construction, is making sure the thing gets complete, because once it's complete, there's value. Nobody really wants to deal with a mid-finished project. So I think when you have the completion guarantees, when you have the PACE payments covered for the entire period, even another year cushion if you needed it to have maybe a ramp-up period cover you too, it's flexible. I think that definitely helps a lot. And then the other thought, and I'd be curious what you structured here, but I find that from when I initially had got into the PACE world till now, acting more as like a major lender that is able to see where PACE could step in across the range of products that we have, I found that it's only got more competitive. Rates have come down. I think when I was looking at this in 17, it was still like in the right around 7, high 6s. It's come down into the 5s. I'm seeing deals that are really bid, maybe even high 4s. I mean, there's a lot of flexibility in that pricing. So I've definitely seen it come down, and I've seen flexibility on exit. So on these deals where you have a 3-year term, are you finding pretty much the CPACE providers able to burn off any kind of exit fees by the end of your construction loan?
Yeah, everything's negotiable. That's what we found. I mean, more and more players are coming into the space, which is driving down, pricing. It's largely, dominated by, non-bank lenders, but there's a couple bank lenders that are, starting to kind of dip their toes, in the water. They either lend to these, non-bank lenders and wanted to kind of replicate their own, or they're just, kind of getting ahead of the times, entrepreneurial banks and see this as kind of the future, because, a couple of years ago, I think, PACE was very taboo, right? And, not too many people knew what it was or open to it, but it's becoming more and more mainstream. And I think that's evident by, a lot of these municipalities and states, launching the CPACE programs.
So that's a great point. And I think that in retrospect, I mean, when you think about it being active just recently, New York City, I mean, it really hasn't had such exposure until, I mean, that's a big move to now have a lot of the, capital see it in their town. But when you think about it, I mean, it was out in California in 2009. I mean, it's wild when people it's like, how long has it been around? It's been over a decade. So I do think, though, that in terms of availability, and then now what I think will be the next lever is more lenders saying, hey, we could probably do something with this and have it be something that there's some playbook for it. Because right, I feel like that happens too. Is sometimes if it's something new, it's like, a lot of times it's just like, we don't have a playbook for it. So like, we kind of like, how do we have to look at it, right? Like when you have a new product come along. So
I think in the coming years, if you're not doing CPACE as a lender, you're not going to be competitive.
Nice. I'm going to use that quote. But in all seriousness, it was funny. I actually just saw, it was a guy that runs the sustainability group for another major international platform. And he said, banks are so regulated. It's unbelievably important, and it's only going to get more to make sure you have an ESG strategy, a net zero strategy that is at the minimum compliant, but something that stands out as a positive. The comment was, don't you think real estate is going to require, like when you have lenders that are going to be now looking at where to make loans, they're going to be looking at, is this something that I could look at that's net zero or at least checking a box for ESG? I think that's coming down the road. I think that's going to be over the next several years. You're going to have much more of a push from, it's not even just regulatory. I mean, you have a bunch of cities, like New York City is a perfect example. Local law 97, there's a penalty if you don't get to a certain decarbonization goal. I think other cities, before they do that, will require transparency. Like they'll require that buildings are open about their metrics around environmental risk, decarbonization goals. And I think what's happening, certainly on the commercial, but I'm curious if you're seeing any trends on the hotel side. Definitely you're finding the tech tenants, a lot of tenants looking at, not even to look at it to stand out, but almost just to be in the comp set of where they could locate their space in a building that has some, in line ESG goals, that's doing the right thing around decarbonization. Otherwise, you're not in the comp set. So I'm hearing that on the commercial side for tenants, like, businesses that are looking for that as a lot of leasing brokers I talk to are saying that's like one of the top 3 questions that you get asked now. And I'm curious if you're seeing any trends or any of the hotel brands that are saying, listen, we're going to differentiate, not just because we know our guests are looking for that more. There's a lot of segments of the population that like to see that the hotel is more sustainable, has a lot more of those features, but that even then there's equity and capital that might be more readily available for that niche. Have you seen anything that's interesting to share about any any of the groups, any of the guys that you work with in your sector doing anything in that regard?
I think most of our hotel clients are very concerned about, does this, add to my bottom line? And if so, how much, and what's the kind of cost benefit, analysis?
Yeah, of course.
One thing that most of our hotel clients, and I think it's pretty, customary, they do charge a small green tax or CPACE tax, per night, per room, of a couple dollars. And that, helps drive a little bit of incremental revenue, to the property.
Let me ask you, because that's a really good point. And I talked about that, a little bit when I was in CPACE. And then I was a little weary because I didn't know how it would be received by lenders. Like I was like, look, you could do this as the borrower. Like you're totally entitled to do this. There's resort fees. There's all sorts of fees that people charge. Why not charge a green fee for making the hotel something that's sustainable and energy efficient and safe, right? I get it. And you're entitled to. I'm curious, has that conversation evolved where lenders will underwrite that as just part of the actual rate? Or are they saying, I don't know, we're not going to count that? How have you found the response to be?
No, they definitely underwrite it to a reasonable, extent. I mean,
so somebody can't add $50 for a CPACE. Like $5 works, like something like, maybe a percentage of the room rate, right?
I think $3, at a standard, limited service, select service hotel.
That's right. It has to be, in line with where you're at. So yeah, for sure.
Yeah.
And maybe on like an $800, one hotel, you could get away with $20 or so.
Exactly. I mean, most of those people, they don't look at their bills, they just charge it to the card and they're done. But
so that's a really great point you brought up, that it's almost acting like a pass through. So if a lender's sizing what's my coverage and they know that the PACE payments are being covered by the $3 add-on to the stay, that makes it also kind of neutral, right? I imagine, or close to it.
I would say it probably covers about, maybe a third or a fourth of the.
So it's a conservative amount that still helps to net down the annual expenses, what you're seeing in terms of like how the numbers are playing out.
Yeah, the lenders will definitely give you credit for it. And we found that even the appraisers, they'll underwrite that as well.
Yeah, I was curious to see how that evolves, because I think that'll be a thing. And then it'll come down to where's the, like how you make other assumptions on what's a reasonable for marketing and G&A and all that. I think there might be what's a reasonable percentage relative to room stay and market for what's, kind of market for a CPACE add-on, $3, $5, depending on factors. But no, that's a very good point that you brought up that I think makes it also interesting for hotels. So Let's walk through who's like an ideal client for you right now. Let's talk about maybe like let's just zero in on hotel guys. Where do you feel like this solution makes a lot of sense?
I think a client that is looking to do a ground up construction project. I think ground up has probably been easier for us to get done rather than the retroactive. And
why is that?
Well, one, we haven't done a retroactive deal, and I think most guys don't, trying to, go back in time and get the necessary, documents or items that you need to, underwrite a retroactive deal. I feel like is just not there. So I think doing it from the start, ground up, construction is much easier for us. We get an energy report done, really kind of, figure out what the PACE loan amount is going to be. And then we kind of work around that. We use that. If we're going to do PACE on it, I mean, we find out the PACE loan amount first, and then we kind of work backwards.
Do you reach out to a PACE provider, or do you go to like an energy audit service provider and say, hey, we're looking at this project, do an energy audit for us and let us know how much PACE eligible stuff is in it? What do you typically find yourself doing?
Yeah, we usually either do an energy report or talk to a PACE provider that has a good pulse, and do kind of a back of the napkin of
makes sense.
what they think is eligible based on the schedule values or the numbers that we provide.
So to date, has it been 4 or so you've done these construction deals? Like they're kind of in that same general range, 80% of cost with PACE. Is it one go-to lender you've been working with, or is it you're kind of finding there's like a couple? What's kind of
there's a couple. I think we've done about 6 now at 80% ground up.
I mean, that's great. I'll tell you, I think when was it? Last year, I was involved with one that was 75, and it was, I think, just a complete customized. It's the thing too, is I think as well as I do, if you have a very strong client and business plan, it's very different than somebody it's their first rodeo. It's like, right. So I think that's also one of the things that everybody needs to just be aware of, is that this is really for folks that have been great experience. They have been able to execute. There's going to be a demand for lenders to be able to make those loans. And then I feel like you could use the CPACE to just get more competitive with it. It's not for somebody who it's a stretch to just get a construction loan or a bridge loan for your project,
Yeah, definitely. Most of, the CPACE providers, they're pitching, hey, it's a lower form of mezzanine capital, right? And, it's 5% versus 12%. So it's a significant difference, but most of our guys are using it just like, mezzanine capital. They build it at 80% of cost, and their plan is to refinance at the end of the 3-year term, pay off the PACE, and get into a long-term fixed rate loan. Now, if the permanent loan has a much higher coupon than the CPACE, and the permanent lender is fine with CPACE, then we might keep it on. But most of the guys, when you're going for conventional, straight up, financing, maybe conduit financing, you're usually having to take that out.
Yeah. I think that's the right move, is that at least have the flexibility. So what are kind of high level terms you're seeing in the CPACE world? Like what's kind of getting done right now for the deals that you're working on in terms of rate and exit fees? Let's say like a 3-year term.
Yeah, 3-year term, anywhere from 4.5% to probably 5.25% on the rate, depending on, who the lender is. And different lenders kind of structure their prepayment, differently. Whether, if you want a lower, prepayment penalty, they'll increase the coupon. They'll get their yield one way or another.
Yeah. I mean, I think that to your point, if you have a construction lender, you're working with these guys and they're doing a 36-month term, I always thought have flexibility at the end of that term so that if you do just need to take them both out, that's at least available. And so I think what's nice about hotels is usually it's 3-year minimum. And I feel like there's a lot of that flexibility once you get past year 2, even though I've seen that also in this space in terms of rates. But it sounds like, 4.5 to 5.25, 0 to 1 point out by year 3, around that, maybe 1 point. Is that, I mean, I feel like that's kind of feels like where we're at, right?
Yeah. And we usually structure, that there's no prepayment penalty, after month 30,
Yeah, exactly. I mean, I think it's definitely gotten that competitive where I feel like you're seeing that even in year 2.
Yeah, or year 2. Some will say after year 2, but it's kind of a moot point. I mean, I don't see, deals, pre-COVID, like we were taking out deals at CO, no issue. Now, at this point in time, we need to see a little bit of, performance and ramp up before I think a lender steps in and takes a construction loan out.
I was going to ask you on that space too. Like, I feel like there's a handful of lenders that don't want to do the construction risk, but they're fine to take on, pre-cash flow or even just minimal cash flow where it's maybe like just a few months in operations. And I feel like that might be interesting too, because there's probably going to be a higher rate relative to the C-PACE, maybe still need also a good year minimum to 2. Are you looking at any deals like that where somebody's looking for almost like an immediate takeout right after they're done with construction?
Yeah. I mean, it really kind of depends on what the STAR report looks like. I mean, if the STAR report, is good and you can, underwrite, to the pro forma and a takeout, I think it makes sense. It's really kind of just getting comfortable, the lenders that, the pro forma and the projections that, we put forth are realistic and achievable.
Have you guys looked at all at like these bifurcations where somebody's looking to bring in a ground lease and use that as a way to get higher proceeds? Is that something that you spend any time with?
Yeah, I mean, just like C-PACE, I mean, we've used, ground leases as well to get, higher leverage. We did a Hyatt Place in the Nashville area about 6 months ago. In between the senior loan and the ground lease, I believe it was 88% total financing.
That's amazing.
So and same thing.
What was just like a little high level on the property? What kind of profile was it?
It was a Hyatt Place. I want to say
Hyatt Place. You said
140 keys.
Yep.
Or so. I think it was about a $20 million senior loan and about a $10 million ground lease.
I mean, that's pretty interesting. I feel like we should definitely talk a little bit more about that. We're kind of wrapping up a little bit, but just high level. I mean, how did you find, because that's also very new for people to do that. What stage was that at? Was that, I forgot, new construction or was that already up?
New construction.
Yeah. So that's also like very, like, you're not hearing that. You're not hearing that somebody's splitting up the ground and they're getting 88% with a leasehold lender for construction hotel, right? So I think, it's definitely what I'd love to do as a follow-up is we should share more about this because that to me is really like between the two products, C-PACE and ground lease, that's kind of what I'm hearing more and more popping up. Obviously, I've been more focused on C-PACE, but I'm looking at both. I think that now seeing that more and more lenders are working together to get there, and there's more folks that have a knowledge and know-how like yourself that are putting that capital stack together. It's just good to be aware that it's now happening. It's not theoretical.
And you have the ability to buy the ground back in a couple of years. So just like you could pay off the C-PACE in a couple of years without penalty, there's a little bit more of a premium or a different formula to buying the ground back. But you have the ability to, you build it, you create a bunch of value and do a cash out refinance and pay off the ground lease, and then you own the dirt again.
I think it's a really good strategy for hotels as well, because it's like, first of all, ground leases have been more acceptable for longer with hotels, but even just the fact that you can repurchase it within 3 years, 4 years, it's still just so much less expensive than if you had to raise all that equity and you own it. It's yours. So you don't give up your destiny. So I think it's great. I think you guys are doing awesome things. So I want to just kind of start to wrap this up, and I really appreciate the perspective. It's awesome, first and foremost, to hear your story, getting this thing going and now growing it over the last decade plus and seeing how you guys have been able to, do some very unique things. I find the hotel space, really is something that it's, a lot of times people say it's an operating business and it's real estate, right? So there's always a way of having to look at it. It's a real specialty, I find. And now being able to bring in some of these innovative capital solutions, C-PACE, bifurcations with ground leases, definitely encourage everybody to look up Nick, Arriba. find out a little bit more about what they're doing and see if that might be something they could help you with. I think that it's always good to just hear about what's actually happening. And sometimes, let's just be honest, sometimes people are promising things. And so it's good to really talk about what's getting done. And a guy like Nick, who's actually getting these done, could kind of just tell you how it is. I think that's super important in our space, in every area when it comes to evaluating new things. So Nick, any last closing words you want to, kind of give a shout out, or anything you want to let people just kind of be aware of or know of?
We're open for business and, actively getting these complex deals, done. I think we're one of the few shops that are, have a track record in hotel construction, and we're actively, in the trenches on, a number of deals. So we have a very good pulse on the marketplace, and, happy to discuss, any transactions or any deals with anybody that, are looking for financing.
Awesome. Nick, pleasure speaking with you today. Thanks so much for having you on. I look forward to talking to you soon. I wish you and the team just continued success and all the best.
Thank you. My pleasure.
Yeah.
We'll talk soon.
Awesome. Thanks, Nick.
Thank you for joining us on another episode of the C-Pace Confidential. Give this episode a like and subscribe so you don't miss any of the fast-coming opportunities in the world of C-Pace. Got a question? Message us on LinkedIn at Adam Harris Lipkin. See you next time for another edition of the C-Pace Confidential.